समझ नहीं आ रहा अपने सैलरी इंक्रीमेंट का क्या करूं।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स के एसआईपी का टॉप अप करा ले। दिस इज द राइट टाइम।
क्या? समझ में नहीं आया।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स का एसआईपी टॉपअप करा ले। दिस इज द राइट टाइम।
अब समझा।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
The value of the domestic currency compared to the dollar is always a political issue for all countries. For some countries, it's a political issue in the sense that it affects governance and economic management, the example being China. In some others, it's an issue of partisan politics. Those are countries like India. These are countries like India, our country, which have a notion of currency nationalism, which means the stronger my currency is, stronger my nation is. China is the opposite. The weaker my currency is, the stronger my nation. Why? Because China is an export-dependent economy. For them, their $1 trillion worth of export surplus is really vital because they cannot consume even a fraction of what they produce. That's why the Chinese keep their currency weak. They keep their currency weak. People don't complain because there is no partisan politics there. It's a single party system. For decades, US has had a fight with China, and that's to do with their trade imbalances. And they say one of the sources of trade imbalance between them and China, besides the fact that the Chinese subsidize their exports in many ways, but the biggest cause they say is that the Chinese carry out currency manipulation. Currency manipulation to keep their currency weak. It's the opposite in India. Why? Because India is largely an import-dependent economy. India has large imports. India has a sizable trade deficit, particularly if you add oil there. If you keep merchandise on one side, that might not be that big, although that's also sizable. But once you add oil, it becomes a very difficult situation for India. So for India, a weakening currency actually becomes a bit of a problem. However, a currency is something which follows its own economic logic. It follows its own economic logic. That is something that Sanjay Malhotra, the RBI governor, explained in his November 24 statement, where he said rupee will depreciate over time because that is the impact of differential between your inflation, other countries' inflation, many other factors. However, in our country, particularly since 2012-13, well, over a 2-year period, that was the taper tantrum period. In the US, there was a tapering of monetary easing that was called taper tantrum. That is the period when Indian rupee also weakened quite substantially. It was in that period that the BJP started attacking the Congress party, saying the rupee is weakened so much, the rupee will soon have the same value as the age of the prime minister, etc., etc. And then also some of us had tried to say that rupee has always weakened. Now you see headlines saying rupee at all-time low. The rupee will always be at an all-time low. Maybe on some days it will go up a little bit, but if you see any significant period, year on year, I would say mostly even quarter on quarter, you will find rupee at an all-time low. Why? Because the rupee has been consistently declining, and I'm saying declining, but I'm making a gesture like this as if it's rising. That's because the amount of rupees you need to buy a dollar is rising like that. If you just want to see how this happens, in about 1999, the rupee was 40 to a dollar. In 2019, it became 80 to a dollar. So in about 20 years, the rupee halved in its value to the dollar. That is no catastrophe. That's how it's been moving. However, now the rupee has crossed the 90 to a dollar barrier. That's a psychological barrier. That's also something that makes a headline. So it looks like the bottom has fallen off the rupee. That may not be the case, but the fact is that there is pressure on the rupee. Now, this pressure on the rupee is also counterintuitive. It's counterintuitive also because it is sort of going against the winds that are blowing in the global currency markets. In the global currency markets, all major currencies in the world have strengthened compared to the dollar. All major currencies except two, that is Indonesia and India. Indonesia, what's happening, we don't have the knowledge to explain to you. And if I had thought you will be so interested in this, I would have read up or called some people, some friends, as I have done in this case, some economists, to try and get some wisdom. But let's leave Indonesia aside. Look at India. Indian currency has weakened against the dollar most of all for all major currencies. Indian currency also is the worst performing currency in all of Asia this year. This year, Indian currency is weakened by more than 5%. In fact, in May is when Op Sindoor happened. Around that time, Indian currency was at its strongest this year, at about 83 rupees, 83 paisa. And the reason it had strengthened at that point was essentially because Prime Minister Modi was among the first to go to Washington, and it looked like India will be among the first countries to get a trade deal with America. That did not happen. At that point, in anticipation of that, the rupee had strengthened a little bit, but then we know what happened after that, Op Sindoor and the fight over credit and punitive tariffs from America. Now, all of that added to the crisis with the rupee. That said, there is a danger of over-politicizing the depreciation of the rupee, because as I told you, the rupee is always depreciating. In most emerging markets, currencies will depreciate compared to the dollar, and where it doesn't depreciate, say in China, they will make sure that their currency doesn't strengthen anymore, because that works adversely to their export interests. To understand how the rupee has moved, because rupee has traveled from 40 to 50 to 60 to 70 to 80 to now 90 to the dollar. It's happened almost in a straight line. You can draw a line like that on the graphics from 40 to 50, and we have this data from Reuters, whose graphic I'm sharing with you. From 40 rupees to 50 rupees, say from about 1999 to sometime in 2010, it took 10 years and 10 months for the rupee to weaken from 40 to 50. Remember, the base is very important. When the rupee weakens from 40 to 50 to the dollar, it has weakened by 25%. 10 rupees over 40 rupees is 25%. It's weakened by 25 rupees. Then the rupee goes from 50 to 60. For going from 50 to 60, it took 4 years and 7 months. That is around time Narendra Modi took over. When he took over, it was 58.87. It declined a little bit more the next month or so. By July of that year, it was at 60 rupees. So it took 4 years, 7 months to go from 50 to 60. So the next 10 rupee decline to the dollar, 50 to 60, took less time, 4 years and 7 months. However, since the base had gone up to 50, in percentage terms, this decline is 20%. This is when taper tantrum and other issues with UPA 2 had also come into play. Those are the ones that BJP or Narendra Modi were complaining about in their election campaign. Of course, then exaggerated claims were made by some very eminent people, including some spiritual people, saying that let Narendra Modi come to power, rupee will go to 1 to the dollar or 40 to the dollar. But you know what? Faith does not drive global currency prices. It is the hard realities of economics, trade, and not emotions and spirituality and faith that drive global currency prices. Otherwise, you can fix any price for your currency if you like it that way. All it will lead to is a massive black market. See what's happening in Iran now, what used to happen in the Soviet Union earlier when their currency was controlled, even what used to happen in India when currency was fully controlled. There was always a street price. Okay, it wasn't 2 times the bank price, but it was at some points 25, 30%, even 35% higher than the bank price. In Delhi, you just had to go to Janpath or in a back street in Connaught Place and find those traders. From 60 to 70, now you're in the Modi era. From 60 to 70, it took 5 years and 1 month. Again, a 10 rupee fall for the rupee from 60 to 70. However, remember, this now amounts to 17%, exactly 16.67, but say for ease of calculation or ease of understanding, 17% decline in the next 5 years and 1 month. Then 70 to 80, again has happened in the Modi era. This is not a black mark. Indian currency will always decline. It's been declining historically. And when it was not declining historically, naturally, then at different points of time, Government of India had to carry out devaluations, as in the 60s and finally also in 1991 with the economic reform. Now that is not needed because this depreciation naturally takes place at its own pace. 70 to 80, the rupee came down in 4 years. Look at this graphic between 2019, roughly in August to 2023, October. That in percentage terms, now because the base has gone up, we started with 40 rupees, now the base is 70 rupees. So in percentage terms, it's 14.29%. Then we come to the big one, that is 80 to 90, and that's been really rapid. The rupees fall from 80 to 90, although in percentage terms, because the base has gone to 80 now, it's twice as much as it was in 1999, 40 rupees, it's now 80 rupees. From 80 to 90, that is the fastest 10 rupee fall in the rupee. And that's taken 3 years and 2 months. Much of this fall, in fact, has come this year. This year itself, the fall has been 5% in the value of the rupee. I took this much time from you to explain to you that fall in the value of the rupee is natural. It's natural, it is expected, it's also healthy. Because if you artificially boost it, then there will be other consequences. Because in the past, when countries have tried to defend their currencies too much or protect their currencies, then predators like George Soros come in and take advantage. That's why he's known. If you Google George Soros, he'll be shown as the man who broke the Bank of England in 1992. Later also, he took advantage of the Asian financial crisis. That's how he built his billions and billions and billions, which he now uses through his various charities to spread his ideas or to implement his agenda, which many countries find subversive. But remember where he made his money. He made his big money because some countries would try to protect their currencies. There will always be Soroses waiting on the wings if you do such a thing. That's why it's healthy and good and virtuous that India lets its currency follow the trend and follow the trends in global markets and find its own level. The IMF only recently, in one of its recent reports, called India's currency management a crawl-like arrangement. Immediately there was a lot of negative buzz. Oh, crawl-like arrangement. Are they calling us a worm? They are not calling us a worm. They are not calling us a centipede or an earthworm or anything. A crawl-like arrangement actually is a bit reformist compared to a stabilized arrangement that we might have had in the past. In a stabilized arrangement, the central bank thinks this will be the value and I will defend this value, which means if the value of the currency goes below that, then the central bank will come and sell more dollars in the market. If the local currency strengthens, then the central bank will come and buy dollars from the market. That is a stabilized arrangement. An improvement on that, a more reformist idea, not the perfect idea. For perfect idea is a free float from the IMF's point of view. I'm talking IMF language now. But a slightly improved idea over a stabilized currency rate is a crawl-like arrangement. A crawl-like arrangement is when you see your trade balance and realities of inflation difference, you let your currency move a little bit. If it moves too much, there is volatility, you intervene a little bit. So you are crawling. So change is crawling. Your currency is falling, but falling at a crawling rate. That is the difference. That's exactly what's been happening. Now, I told you earlier that all other major currencies have been strengthening compared to the dollar. Why is that happening? And then I will tell you why is the rupee weakening? Why is the rupee doing this counterintuitive thing? Other currencies are strengthening because the dollar is weakening. The dollar is weakening because that is precisely Donald Trump's idea. Donald Trump's guru or teacher in his new approach to the economy and monetary policy is Stephen Mirren. Stephen Mirren is somebody we've talked about earlier. Stephen Mirren wrote a paper basically saying that global trade needs to be reorganized and dollar is too strong, and because the dollar is too strong, industry has gone away from America and has gone to China. I'm sharing with you a link to his paper, A User's Guide to Restructuring the Global Trading System. And there he says it's important for the US to weaken the dollar. Now, Jerome Powell, the Fed chairman, is very independent. He's not following Trump's advice, weaken this, strengthen that, cut rates, don't cut rates. He's been doing his own thing. So what has Trump started? Trump has started attacking. He's following two methods to weaken his currency. One is to keep on attacking his Fed and its credibility and putting pressure on Powell to cut rates. And second is to threaten and to spread rumors that he's going to replace Powell with one of his key people, either Scott Bessent or Stephen Mirren. If any of these takes over as the Fed chairman, then rate cuts will become much faster because Trump has been asking for rates to be cut. Now that brings them a second benefit, a different kind of benefit, which is what the mega lot want. And that benefit is as rates on US bonds come down, then fewer foreign sovereigns, foreign investors will come and buy American bonds, which means the dollar will weaken further. So they are interested in weakening the dollar. That's why the dollar is weakening, and that's why other major currencies in the world are rising. Now, why is India going in the other direction? If everybody is going in this direction, why is India going in the opposite direction? One is a very simple explanation that India has been hit by American trade tariffs more than anybody else. That has increased India's trade deficit, particularly merchandise trade deficit. That's a reality, but that's only a small part of the picture. Okay, a part of the picture, but not a big part of the picture. The other problems are that this year India has seen a large amount of outflow of foreign portfolio investments. It comes to about $17 billion. See this chart? It's also seen much less FDI this year. And you can also see how FDI has been declining month on month this year. It's almost come to a negligible level. In fact, if you look at the full data for the year, India has received gross inflows of $6.6 billion, but at the net level, there are outflows of about $17 billion. That much money has gone out of India. This year, foreign portfolio investors already, till about a month back, had sold from Indian stock market $16.7 billion worth of equities. Now, that may be because they think Indian markets are too highly priced, or they might think, in fact, that some markets are cheaper. So, one economist I was speaking to said that, look, everybody was anticipating a China plus India situation where investments will move from China into India. But what we are seeing right now is an India plus one situation where that plus one is China. So the roles have reversed, and instead of coming to India, the flows are going to China, including foreign portfolio investments are now going to China. That situation is reversed for India, and that has worked badly for Indian rupee as well. As I told you, it's not as if FDI has not been coming in. At gross level, 6.6 billion has been come in. You see net outflows also because a lot of people who had invested in Indian companies, particularly the startups, they've pulled out their money with profits after IPOs. You've seen this flurry of IPOs in the Indian markets. Many of these involve foreign investors who, why did they invest in these companies? They invested in these companies to make profits. So they pulled out their money profits because after all, their managers also want to be paid their bonuses, their shareholders want their dividends, they also want their stock prices to go up. You can always hope that those who pulled out their money and made good profits will come back and invest again in India. Now, let's try and understand it a little bit simply. What is balance of payments? Now, again, it's quick tutoring from a very dear economist friend of mine. Balance of payment consists of two elements. One is the capital account. Capital account means FDI, FPI, that is foreign direct investment, foreign portfolio investment, what used to be called FII earlier. That is the capital account. Second part is, and the most important, current account. Current account is your balance of trade, your export and imports of merchandise and services. Services are holding out, but your balance of trade on merchandise has gone completely south, in the sense that India always had a deficit. Now the deficit has gone up. In October, September, deficit's been high. Also because India has been importing a lot of gold and silver. A lot of the gold and silver people have bought just as a store of value. That's why a lot of the imports recently have been in the form of bars and coins, not jewelry or not to make jewelry. This is because people see it as a storehouse of value. They are afraid of inflation. They are afraid of falling value of the rupee. The second reason gold and silver imports have gone up is because a lot of people have moved into gold and silver ETFs. So once they move into exchange traded funds then have to backstop their instruments with physical metal. And that's why these imports have gone up. All of this has put pressure on the rupee. Usually this deficit will be covered by capital account, which is your FDI and FPI. which, as I explained to you just now, has been negative this year. That's the reason there's been even more pressure on the rupee. Now, what happens is once the market knows that your currency is declining or depreciating fast, then two things happen. One, exporter said, listen, let me hold back on my exports, because if I export later, I will get more money for the dollar that I get paid. So today, suppose I export $1 million worth, I will get $1 million multiplied by 90. If I anticipate that in 2 weeks it will be 92, or 3 weeks it will be 92 or 93, I'll hold back. So for the same export, I will get 93 to a dollar. So exporters hold back their exports if they can delay it. Importers, on the other hand, hasten their imports because they are concerned that if I import later, I will pay more in terms of the rupee. So this then becomes a vicious cycle, which is that you think my currency will weaken, and that's why exporters hold back, importers fast forward their imports. That brings in further pressure on the rupee. Now, what is it that the RBI can do? RBI in the past has intervened in spot markets. Spot markets, RBI goes and buys a bunch of dollars. They never state it, they never declare it, but the market figures out. What happens is, when the RBI sells dollars in the market, they sell dollars for something, they don't give them for free. That something is the rupee. So as RBI sells dollars in the market, they suck in the rupee from the market. That's sucking in the liquidity. What happens? Then market is short of rupees. Market is short of rupees, interest rates go up. That also answers the question which many people ask, that RBI has been carrying out this interest rate cuts, but the yields on Government of India's 10-year bonds, or 10-year G-Secs as these are called, government securities, these are not coming down. They still remain in the 6.5% ballpark. That is too high an interest rate for Government of India to pay at a time, particularly when inflation is so low and RBI is cutting interest rates. One of the reasons contributing to that had been that the RBI was selling dollars in the market and sucking in the rupees. That the RBI has stopped doing lately. Until July this year already, RBI had spent about $32.7 billion, that is the estimate, in supporting the rupee. But since then, they've stopped doing it. What they've done, on the other hand, is to take a forward position on the dollar, a forward position by 3 months. That is a forward position equivalent of about $60 billion over 3 months. That is, after 3 months, they will deliver this many dollars, whatever the price on the day. So the hope is that by that time, rupee would have strengthened a little bit or stabilized a little bit, and there will be no loss. But it's a call that the RBI has taken. So RBI is now sitting on a forward position of 60 billion. Can they do more than that? India has still enormous foreign exchange reserves, at this point about $693 billion, bit lower than the peak. So you can see that the RBI has been selling. But beyond that, for the RBI to intervene will be tougher, because if RBI starts intervening and word goes around in global markets that Indian RBI or Government of India, particularly because they are under political pressure, they have fixed a notional target rate for the rupee to the dollar, then these global predators will come stalking the rupee. Also, to understand very briefly the implications of a weakening currency. The implications are positive implications. One, your exports become more competitive. And second, India is the largest recipient of remittances in the world. We have so many fellow Indians who live overseas and send money back. That is $137 billion, according to World Bank figures for 2024. All that money, all the dollars that people send to their parents, to their siblings, to their families, all of them get them more rupees for the dollar than before. So those families have more to spend. This is the positive side. On the negative side, your imports become expensive, particularly your oil imports. Because we are an import-dependent economy, this can lead to imported inflation. That's where India is a good hedge right now, because the inflation rate is so low. Once again, in conclusion, all of this data, what does it tell us? It tells us, one, that the rupee has always depreciated and will continue to depreciate. So the fault lies not with the fact that the rupee is depreciating, or the government of the day now, or the government of yesterday or day before yesterday. This is the way global economics works. The fault lies with those who made exaggerated promises that let this government come in, it will be 40 rupees to a dollar or 1 rupee to a dollar. Now, fault also lies with those who bought into those promises. Because remember that a strong currency is not necessarily a good thing. Some of the strongest nations try to weaken their currency. The Japanese have tried to do this over long periods of time. That said, you can see that the decline or depreciation in the rupee has been quite natural, quite predictable. You see some jumps here and there, but ultimately you can draw a line like this. The rupee to dollar keeps declining at a particular rate. The only thing that is different this time, which is counterintuitive, is that rupee is weakening even as the dollar is weakening, but other global currencies are rising compared to the dollar. That is the nuance I try to, quite bravely I think, for a non-economist, I try to explain to you in this episode of Cut the Clutter.